All right, welcome to the Explainer. So, if you're getting into finance, one of the first things you've got to learn is how to look past the big headlines and really figure out if a company is healthy or not. Today, we're going to give you the framework for that, a quick but super powerful financial health check. Let's jump right in.
So let's kick things off with a question I hear all the time. You see a headline, company hits $1 million in sales. Your first thought is probably, wow, they're killing it. But is that really the whole story? The short answer? Not even close. High sales numbers can actually hide a whole bunch of problems under the surface. To get the real picture, you have to dig deeper. It's kind of like a doctor wouldn't diagnose you just by taking your temperature, right? You need a full checkup. And that checkup, well, it's got 3 essential steps. Think of them as the vital signs of a business. First, we're going to check its profitability, then its liquidity, and finally, its efficiency. Put them all together and you get a real diagnosis of how that company is actually doing.
First up, profitability. This is the big one, you guys. This answers the most fundamental question of all. When all is said and done, after all the cost and expenses are paid, is this company actually making any money? This tells us if it's built to last.
Now, it's easy to think profitability is just making more than you spend, but it's way more nuanced than that. It's really a measure of effectiveness. How good is the company at turning its day-to-day operations into cold, hard profit? That's what tells you if it's going to be around for the long haul. To measure this, we've got a few key tools. And don't worry, you'll find all the data you need for these in a company's financial statements, like the income statement and balance sheet. We've got net profit margin, return on equity, and return on assets. For our health check today, we're going to focus on net profit margin. It's just a fantastic, straightforward way to see how profitable the core business is. Okay, so for our example company, we run the numbers, net income divided by revenue, and boom, we get a net profit margin of 20%. As an analyst, a number like this starts to paint a really clear picture. And here's what it means. For every single dollar that comes in the door from sales, a full 20 cents drops to the bottom line as pure profit. Now, you always have to think about context. For a grocery store, a 20% margin is basically a fantasy. For a software company, it might be just average. But for most businesses, a 20% margin is a great sign. It shows they've got strong control over their costs. So on profitability, this company gets a thumbs up. Okay, so the company passed the first test with flying colors. But what's next? Well, that brings us to yardstick number 2, liquidity. If profitability is about long-term strength, think of liquidity as its short-term survival instinct. It's the company's financial lifeblood. And this is absolutely critical. A company can be wildly profitable on paper and still go completely bankrupt if it runs out of cash to pay its bills right now. Liquidity asks a very simple, very urgent question. Can they pay the bills that are due tomorrow? And again, we've got some great tools for this, mostly pulling numbers right from the balance sheet. The most famous one is the current ratio, but we also have something called the quick ratio for a tougher look. Let's start with the current ratio for our company. So we take the company's current assets, that's things like cash and inventory, and we divide them by its current liabilities. We crunch the numbers and we get a current ratio of 2.0. Now that number, 2.0, tells a really important story about whether this company can weather a storm. What it's telling us is that the company has $2 in easily accessible assets for every $1 of bills it has to pay in the near future. That is a very comfortable cushion. Generally, you want to see a ratio over 1, so a 2, that's a fantastic sign that they're in no immediate danger. Another clean bill of health here. But what if you're a skeptic? What if you want to put the company under some real pressure? Well, that's where the quick ratio comes in. It's basically a financial stress test. You calculate it the same way, but you take inventory out of the assets. Why? Because you can't always sell your inventory in a hurry. The quick ratio asks, can this company pay its bills without selling a single product off the shelves? It's a much tougher test. Okay, so our company is profitable. It's got cash. It's looking pretty good, right? But there's one more piece to the puzzle. Our final checkup, efficiency. This tells us how well the company is using everything it has. Is it a lean, mean operating machine, or is it kind of clumsy and wasteful? In other words, efficiency is all about getting the most bang for your buck. I mean, a company has all this stuff, right? Factories, computers, piles of inventory. The efficiency yardstick tells us how good they are at using all that stuff to actually generate sales. So how do we measure it? We use turnover ratios, things that connect the income statement and the balance sheet, which is pretty cool.
We can look at asset turnover, receivables turnover, but let's zoom in on inventory turnover to see what we can learn about our company's operations.
So, we run the numbers for inventory turnover, taking the cost of goods sold and dividing it by the average inventory, and we get a 5.0. What does that even mean? Well, it means the company basically sold and completely restocked its entire inventory 5 times over the year. That's a great sign. It means products aren't just sitting on shelves collecting dust, they're moving. Now, just like before, context is everything. A 5 would be amazing for a car dealer, but maybe terrible for a bakery. But for our general checkup, it points to a well-oiled machine. All right, we've done it. We've checked all 3 vital signs. We've looked at profitability, liquidity, and efficiency. Now it's time to step back, put it all together, and give our final diagnosis.
And listen, if you take away only one thing from this whole explainer, let it be this. You can never judge a company's health by looking at just one number. It's so tempting, but it's always misleading. A company can look profitable, but be days away from running out of cash. Another can have tons of cash, but be using its resources so poorly that it's doomed. You need the full picture. Real insight, real understanding only comes when you put all 3 of these yardsticks together. Profitability shows you its potential for long-term success. Liquidity guarantees its short-term survival, and efficiency proves its operational strength. When you see a company that's strong in all 3 areas, that's when you've found a truly healthy business.
So, to leave you with something to chew on, think about this. For a massive, complicated, global company like Amazon, which of these 3 yardsticks would you pay the most attention to, and why? Would it be their famously thin profit margins, their incredible cash flow that fuels liquidity, or their absolutely world-class efficiency? What do you think? The answer tells you a whole lot about what makes them tick. Thanks for tuning in.